what I'm looking for in a CEO when analyzing a stock. I think there's two things that are important to me. First, they're not the ones working in the warehouse, but they have to set the culture and the business direction and essentially, okay, are we working on this or that?
A company based out of Canada, and their 5-year CAGR returns, according to FinChat, is 31.2%.
We talked about how he could surpass Buffett if he does this for a longer time period. This is better than Buffett over a 20-year period. However,
all right, folks, welcome to Investing for Beginners podcast. Today we have a really fun show and we have a new guest. We have Brett Schafer from Chit Chat Stocks joining us. Brett is going to be a regular guest with us a couple times a month. So he's going to provide another viewpoint on stocks and all kinds of fun stuff. So smart guy. If you haven't heard his show before, after you're done listening to this, go subscribe to their show because it's well worth your time. It's easily one of my favorites. So Brett, thanks for joining us today, and we're looking forward to chatting.
Yeah, thank you for the kind words. And yeah, check out the Chit Chat Stocks podcast if you like this one as well. Been doing some work with investing for beginners and all the other stuff like Value Spotlight that you guys have going on, and excited to start joining the show on a regular basis. We got a really fun topic this week, and excited to just talk with the audience, and hopefully we got a fun show for everyone.
Yeah, exactly. I don't think we'll put them to sleep today. So maybe in future, but not today. All right. So today I thought we could talk about some of our favorite CEOs, and maybe we could talk about their impacts on our portfolio, what we think of them, and those kinds of things. So we thought maybe we could start off by just kind of swapping back and forth. I don't know who Brett's going to reveal. I did reveal mine to him, so these won't be any surprise to him. But I guess, why don't you go ahead and do your first one?
Sure. And before I do this first one, I want to maybe say, in general, what I'm looking for in a CEO when analyzing a stock. And I think there's two things that are important to me. First, it is business direction and essentially guiding the ship, because especially at larger companies, these people they're not writing the code. They're not the ones working in the warehouse, but they have to set the culture and the business direction and essentially, okay, are we working on this or that? What are our strategic priorities? And just analyzing that, that's kind of one key thing people look at. But the second one that's very important to me, and probably just as important, is capital allocation. So that can either mean investing in capital expenditures smartly, or being smart with their operating expenses, not wasting money on marketing, or it also means returning capital to shareholders through dividends or share repurchases. So without further ado, my fifth one on the list, we're going to go from my top 5 down to the bottom, although I could interchange some of these depending on the day. So I think I just like all 5 of these very much. It's going to be Coupang and the CEO, Bom-Suk Kim. Apologies if I'm saying that incorrectly. It is a Korean company. So why do I like Bom-Suk Kim? He founding this company, he essentially learned kind of like a junkie from all the other successful e-commerce platforms out there. He seems extremely ambitious and founded and built what looks like now the best e-commerce offering in the world with Coupang. It is definitely the best in South Korea, for example. If you think that Amazon Prime is a good service, you can buy items on Coupang by 12 a.m. midnight and get them delivered by 7 a.m. the next morning. You can get fresh groceries delivered within a few hours, if not sooner. And one thing they highlighted on the recent conference call, you can get, if you buy appliances on Coupang, they will send someone to install it and in your own house. Or if you buy tires with them, they will send someone to change your tires and rotate that for you. So it is a high quality service, all for an Amazon Prime-like subscription. And they are now officially, with $30 billion in annual revenue, one of the dominant retailers in the country of South Korea, after beginning their journey as an Amazon, we'll call it a clone. They did copy a lot of their strategies, but they did it successfully. They copied them around a decade ago. If I'm looking at Bom-Suk Kim specifically, he has said in his actions that he's focused on the long term, generating and growing free cash flow per share, and has fostered a culture of innovation at the company that is bearing the results while still staying self-funding, still staying profitable, generating positive free cash flow. And I just love what they're doing over there, and the culture and the business model and the competitive advantage they've built.
It sounds awesome. I know you guys have talked about that from time to time on the show, and you kind of answered the question I've always had in my head. Is it really that much better than Amazon or Mercado Libre? And to me, those are kind of fighting words. So, it's interesting. I mean, I love that idea about what they do for their version of Prime. I mean, can you imagine how popular that would be here?
Oh yeah, and they have it a little bit easier than Amazon and especially Mercado Libre because when you look at South Korea, it's a much smaller geographical country, and you really have one giant city they need to target. They've talked about before how they have their own delivery drivers that might just target one apartment complex or one block for their day, but they have tailored the service to the wants and needs of the local Korean population, and that's why they've succeeded while outsiders have failed.
Mm. Is there any plans of them expanding outside of Korea at any point?
So they're expanding to Taiwan. It's going quite well. I think they were growing revenue at a double-digit pace quarter over quarter. They're trying to replicate the offering that they have in South Korea over there, which is essentially building a vertically integrated system like a Mercado Libre or Amazon. I kind of think I wish it wasn't Taiwan because it's such a, the Chinese threat there is just tough, but they seem to be doing quite well over there. They have talked about Southeast Asia a bit, potentially a Singapore, but for the time being, I trust management to do what's right. They have not thrown good money after bad. They tried to expand in Japan, but they really weren't able to knock off, Amazon's been quite successful over there as well as some local players. They weren't really able to make a dent in that market, and they pulled out of there. So I trust them to either refocus on the South Korean market, or if they find some other areas where they're actually getting a good return on their investment, to invest heavily. But I don't have the thesis on the company and the thesis on the management isn't necessarily that they're going to expand somewhere else. It's that they understand capital allocation correctly and will do so, hopefully, in an intelligent manner.
Yeah. Well, chances are if they've done it well in the past, they will most likely continue to do it in the future.
I agree.
All right. So I guess kind of starting down my list, these are in no particular order. And I agree 100% with everything that Brett said about capital allocation and who the drivers of the business. And these are easily probably the most important people and for the companies. And you can really look to them for the returns that you should expect. So my first one's going to be no surprise to anyone who's ever listened to the show, even for 5 minutes, and that's Warren Buffett. So the Buff Dog, 94, 95 years old, still got it. The company has returned over 22% CAGR over the last 5 years, which was kind of a surprise. I looked that up on FinChat, and that's what FinChat told me, so I believe him. Buffett has generated returns on equity over the last 5 years of 13.2%, which is not too shabby, especially for a industrial kind of insurance conglomerate that he's built there. And I guess some of the things that I really like about what he's done is some of these other CEOs I'm going to mention have kind of maybe not copied him directly, but have certainly taken from this idea where he really is working on decentralizing the business and removing himself from the operations of the business. So when they purchase other businesses like BNSF or anything else that they See's Candy, he doesn't put his fingers into the operations of the business. So they find these great companies and allow them to keep doing the great things that they do, and just kind of sitting at the home office collecting the cash and using it to buy equities. So he and Charlie realized very quickly on that they're good businessmen, but they don't know anything about running a candy store or running a railroad or such. And so they let those people do that. His specialty was really insurance. And so that's what he and Charlie focused more on. So I really like that about what he's done. And he's also, the other thing that I really like is, I mentioned he's 95. So not to be morbid, but he's not going to run it forever. And at some point, he's either going to step down or not be with us to run Berkshire. So the thing that I like is he's been setting up a succession plan for a while now. And he's put people in place to take his place, understanding that filling his shoes is going to be near impossible. So you're going to have to find somebody that has the will and the strength to continue to follow Buffett's path, but also be strong enough to make their own decisions. And the other thing that I think he's done really well is he's been reducing his stock portfolio, in that he had a 50% position in Apple, and I know I don't have the the will or the stomach to handle a position like that. And this is just my take, so take this for what it's worth, but I feel like he's been reducing some of his larger positions to give Greg Abel, when he takes over, not a headache of having to deal with, can I handle this? And he's also, by doing that, built up a lot of cash on the balance sheet, which I know he's taken a lot of heat for, but it also gives him optionality. So if Greg decides, you know what, I can't allocate like Buffett did, I can start paying a dividend. He's got a lot of money to do it. So if that's something they want to do, he's got the option to do it. So those are a bunch of things. Besides, Buffett has been the probably premier capital allocator while he's been running the ship, and I don't see any reason why that's going to stop until he retires. So that's why he's on my list.
Yeah, you can't really argue with Buffett. Best, probably indisputably, maybe Mark Leonard, if you give him another decade, could run up there too. But indisputably, right now, the best capital allocator ever, at least for the, you count the longevity plus the actual underlying returns of the business. I do like your idea of, okay, we're not gonna load up this new management team with kind of a headwind with owning a huge stake in Apple or some other businesses when Apple is trading at close to 40 times earnings and not really growing much anymore, even if the business is still, high quality and that brand is still rock solid as it's ever been. I do like the idea as well of, I think it would be a fun story if they eventually just said, we're going to pay a $300 billion special dividend. We've generated all this surplus capital in the long term. We can't do anything with it. And hey, look, you might get for people that have held it for the long term, a 20,000% dividend yield on this one payout here. One thing, I guess, Buffett is indisputable as a capital allocator. One thing that just keeps me away from investing in them today is just the size and the coverage. So do you own Berkshire Hathaway, or do you look at them as kind of a case study on how to analyze other businesses?
Oh, I own them. I've owned them I think I bought my first shares 6 years ago, and it's my largest position, and I've held it for quite some time.
Hey, and that return CAGR, that surprised me as well. Was that a 22% over the last 5 years?
Yeah.
Wow.
Yeah.
I guess we're comping the COVID lows a bit, but even so, that's some impressive stuff. And I think Ryan, we actually just talked about that. Ryan's the co-host of Chit Chat Stocks. We talked about recently that Berkshire has beat the market over, I think, 30, 20, 10, and 5 years.
Right.
So pretty good.
Yeah, pretty good. Pretty good. Yeah, he hasn't lost it yet.
Exactly. All right. You want to hear my number 4?
I do.
Okay, this one is probably the most controversial, but I think if you look at the results, they are undeniable. It's going to be Brian Chesky at Airbnb.
Oh.
Now, I maybe this is one of the pop deck because it's recent. There may be some current concerns about how he looked. He looked kind of sick in a recent podcast appearance, but you cannot deny the performance of Airbnb, the results leading Airbnb since its inception. He has founded the business and is still leading it today, despite them putting up, say, lofty goals, ambitious goals that they have not reached in the past. Well, it's kind of one of those, you shoot for the stars, land on the moon. Is that the saying?
Yeah.
And I believe he understands capital allocation correctly. He has taken this platform from nothing, created a whole new business model, a whole new way of just traveling. And now they're closing in on $100 billion in gross booking value annually. They've weathered many storms. I mean, think about COVID. We just mentioned that. That was an extremely tough period for Airbnb to operate. I think that has really shown, one, that he's a skilled CEO, and that's a position that fits well for him. And two, he has that experience now. He can be much more wise as, there's going to be other downturns in the future. It's now a cash flowing machine. And I do believe, given their buyback program, given what he learned coming out of that growth at all costs startup mode to weathering the pandemic and kind of getting really efficient on spending and how, return on invested capital. I think he understands capital allocation now, and that's kind of what's elevated him as the founder, similar to Bom-Soo Kim, with that strategic vision, along with understanding capital allocation and returning capital to shareholders through buybacks.
Yeah. I truthfully didn't know much about him or the company, but you guys did a breakdown on Airbnb and you've talked about them several times, and that has really helped me understand them better. I don't currently own the company, but it is something that I have looked at from time to time because it's interesting. And I love how you talk about how he's kind of evolved and is evolving. And I think that is a mark of a good CEO, because no company, well, unless you're like Johnson & Johnson or Visa, is going to stay in the same kind of trajectory that they are for a very long period of time. So they're going to go through growing pains, if you will, and how they evolve their ideas of capital allocation will go a long ways towards how successful it will be in the long run.
I agree. And with Airbnb, I don't own it either, but it is on the top of my watch list, and the stock, I think, is in a 20% drawdown now. So it's getting cheaper. I don't know if I'd consider it cheap yet, if it's in my buying territory, but it's definitely one I like, and I would like to make a buy and hold position if the right price materializes, because again, I do believe in the long-term competitive advantage of the platform, and I believe in Chesky.
Yeah. Well, I mean, to me, the fact that Airbnb has kind of become a verb is a signal to me that they've done a really good job of building a brand that people like and want and will continue to use.
Yeah. And did you know, I hope I'm getting this stat right, I think I remember correctly from the earnings call, 60% of their bookings now come from directly starting your search within the Airbnb application.
Wow.
I think 4 websites. So 60% are skipping the Google take rate tax on, say, instead of going lodging in Madrid, you start your search on Airbnb. So you know for a fact that they're guaranteed to book with Airbnb on 60% of these searches now, and that's growing over time. So I think that shows, again, their widening competitive advantage.
Yeah, for sure. That's a great one. Good choice. All right. You want to hear my fourth one?
Let's do it.
All right. So this one is, you kind of teased him already. So the next one is Mark Leonard. So Mark Leonard is the CEO and founder of Constellation Software, a company based out of Canada. And their 5-year CAGR returns, according to FinChat, is 31.2%. So kind of redonkulous. And he is probably easily, would you say, one of the most reclusive CEOs you've ever come across. I think there's only 2 or 3 known photos of him on the internet. And
yeah, that is wild. I think I have one. Well, 2 people, I guess. One, my last one's a little bit cheating, but it's one company that are also recluse, but not nearly as recluse as this, where you write some shareholder letters from time to time. You stop doing them on an annual basis, but the only way you can really interact with him is going to the annual shareholder meeting.
Yeah.
So yeah, he is. What's interesting is they are a digital acquirer of digital businesses, but he seems to not want to have any online presence.
Right. No, none whatsoever. Yeah. It's the most amazing thing. And kind of like Buffett, he didn't model this after Buffett. I think he modeled it after Illinois Tool Company, but it's very decentralized, and he pushes all decisions down the food chain. And so he has set up the business now so that the subdivisions of the subdivisions of the subdivisions make a lot of the decisions to buy these very small companies. And they have created an amazing culture that allows the company to continue to succeed. And the overarching narrative that people, when they poo-poo Constellation Software, is that they're going to run out of targets to keep buying. And every year they buy more and more and more, and they keep generating more and more returns, better revenue growth, same level of profitability. Those things don't change, and it's just become a machine. And now he's starting to spin off some of the divisions like Topicus and more recently Lumine. And those are other ways that he's figured out how to generate more returns for shareholders by spinning off these valuable divisions as standalone companies that Constellation Software still has ownership stake in, so they benefit from their success, as well as he has a super share for both Topicus and WooMine, so he can override any decisions if he needs to. And so to me, it just, everything he does, I think it's just so stinking brilliant. And when you listen to his meetings or read his shareholder letters, which by the way are must read, and he's so smart, and he's one of those people that he makes it look easy when you know it's not easy.
Exactly. And this might be, I'm pulling up a stat here on FinChat, it might be underrated because of those spinoffs, but they went public, and this is the Toronto listing, so it could be different in US dollars for anyone that is looking at this up themselves, but they went public in 2006. And since then, the total return compound annual growth rate, or just annual returns on a total return basis, 36.6%.
Right.
That is, we talked about how he could surpass Buffett if he does this for a longer time period. This is better than Buffett over a 20-year period. However, Buffett's been doing it for 50 or 60 years now.
Right.
So I'd still give Buffett the clear lead at the moment.
Yeah. A couple other things about Leonard that really kind of, to me, set him apart. When he travels, he would opt to travel coach, and he would stay in budget hotels when he would travel because, as he put it, I'm not comfortable spending shareholders' money. And so he would buy cheap. But as he's gotten older and he's had back problems, he, out of his own pocket, buys first-class tickets or buys nicer hotels to stay in because he needs it for his back, but he still doesn't put it on the company, ticket, which to me is kind of amazing. The other thing is that when they give the bonuses to their managers for hitting their targets, instead of, they give them stock options, but they have to buy them in the market, and they have to hold them for 5 years, and they have to spend 75% of the bonus on buying shares of the company. And that to me is unheard of. And that really, to me, puts a whole lot of skin in the game for the people that are managing the business. And I love that. I just think that is just so brilliant.
He's a smart guy, and it seems like he's aligned all the incentives for all the stakeholders at play. Although, if you're a user of one of the software programs, sometimes you might be frustrated if it looks clunky and old. But
right, yeah, because it probably is.
Yeah, exactly. All right, my number 3, and this is one that is perhaps underrated because I actually forgot his name. But it has been impressive to see the results of what was thought of as a stodgy business getting turned into a little bit of a growth name again. And it is American Express's CEO, Stephen Squeri. Hopefully I'm pronouncing that right, Squeri. He has been with the company since 1985, so he just rose through the ranks and became the CEO in 2018. And since then, card members have begun to grow again. They have got from, after losing the Costco deal, from playing defense to try to retain customers to playing offense and attracting more and more of that premium customer base around the world. They are smartly marketing and targeting their cards to younger people now, which are going to have long lifetime values. They're expanding their acceptance rates at merchants internationally while also keeping up that essentially equivalent acceptance rate to Visa and MasterCard in the United States. And they're reinvesting into broad marketing to promote their premium brand again in a smart and modern manner. They essentially modernized this business and did so while he has been at the helm. And again, I mentioned the buybacks, I mentioned the capital allocation. This is a consistent returner of capital to shareholders through buybacks and dividends. And you just see that share count go down and down and down each quarter.
Beast of a company. Absolute beast of a company. And what I really like is that it's not a turnaround per se, but it feels like a turnaround. And I feel like he's made American Express air quote relevant again, because
reinvigoration would be
there's a better word. Yeah, that's a good word. Yeah, I like that. To me, that's exactly what he's done, is he's reinvigorated the business. And when you think of, I'm older, so when I think of American Express, I think of the American Express, traveler's checks, and I think of this kind of old, stodgy, fuddy-duddy company, and it's not like that anymore. It's changed quite a bit under his leadership.
Yeah, I may be getting this stat wrong, but I think 50% or maybe even higher of their new card acquisitions are millennial and Gen Z. I think that's great. If they start their relationship with those customers now, they're going to be earning, hopefully, you kind of go through that hump of earnings through your, as you age, where your peak earnings are usually in your 40s and 50s. If they're getting people in their 20s and 30s and they have that long-term relationship with them, they can grow spending with them over time. And it just reinforces that competitive advantage.
Yeah, absolutely. And what I've noticed from working in the restaurant business for all those years is that people that used American Express cards loved it. Like people that have a Capital One card or whatever, okay, fine. But American Express people are proud that they have the card and they love the perks that they get with it. Once that you get into that ecosystem, people don't want to leave.
Yeah, I think they spent $14 billion on customer perks in 2024. And I think the reason I like it, and I can speak anecdotally as someone who uses the cards, is they can be quite nice. So they can give you a lot of value that counteracts those high fees, but given their scale and given the fact that they own their own card network, they're going to still make a lot of money.
Yeah, for sure. Yeah, for sure. Yeah, that's a good pick too. You got some good ones so far. All right. All right. Number 3 for me is Peter Vanderdoes, who is the CEO of Ahern. So their 5-year CAGR return is 16.8%, and the company has generated returns on equity over the last 5 years of 26% plus. So this is another payments company that seems to be popular in my portfolio, but these guys are a cut above. So one of the many things I like about what Peter has set up at Ahern, when they hire people, so this is kind of a culture thing. When they hire people, every new hire has to meet with at least one member of the C-suite board. It doesn't all have to be Peter. It could be the CFO. It could be the COO. It could be other people. But every new hire, from the lowest person on the totem pole to senior developers, all have to meet with this at least one person from the C-suite. And to me, that's amazing. When I worked for Wells Fargo, I can't imagine meeting the CEO at the time, working as a personal banker in Minnesota. Like, that's just unheard of. And think about how that kind of sets up the culture of the business, of what you're going to do and how they're going to do it. And I also love the fact that they know what their niche is and they focus on it. And they do kind of play around with other parts of their product and try to expand a little bit, but they understand that enterprise customers are their bread and butter, and that's really where they focus. And after doing a whole bunch of research on not only Ahern, but just the whole payment system and the ecosystem, another thing that really sets them apart is they have one platform. So a lot of these other companies that they're competing against, for example, First Data, they were very acquisitive companies. Ahern has never bought a single business ever, and they don't plan to. And so they build everything from within. These other companies are amalgamations of different systems all put together, and they have not all been, how shall I say it nicely, efficient or effective in working together. And so they don't always present the best customer experience. So when somebody signs on with one of these other payment systems that's kind of Frankensteining everything together, it doesn't work very well. And one of the things that sets Ahern apart is it's a kind of a one-box system. You unplug it, you put everything in, it works right away. There's not a lot of bugs that need to be worked out, and it saves the companies that use them a lot of money. So I love the fact that they do that. I also love the fact that they don't have any stock-based compensation at all, and the management is paid. There's a CE pay ratio here in the United States. It's a requirement now for companies to list what their pay ratio is compared to the average employee for a business. Most bigger businesses, Visa, MasterCard, for example, are 180 to 250 to 1. And Ahern's is I think it's 7 to 1 or something crazy like that. It's super, super low. So what Peter gets is only 7 times bigger than the average employee at the company. And he doesn't have stock-based compensation, juicing up his returns, if you will. And so to me, that sets it up as hey, I love what we're doing. We're all in this together. And if the business does well, we're all going to do well. And I really like that. So it's been one of my favorite companies. I've owned them for almost 5 years now, and I'm a big fan of what Ahern does, and Peter as well.
Yeah, fantastic pick. I think I would have chose them as well if
I hadn't.
if you hadn't. Yeah, I'm still kicking myself for not, because I followed the company, and not as long as you have, but in 2023, I followed the company, and the stock got quite cheap, down about $7 on the ADR, which is the U.S. listed. They're a Dutch company, so they have this U.S. listed ADR. The ticker is ADYEY. If anyone that's listening wants to look at that, but it got down to $7 in late 2023. I should have bought because I believed in the company, and now it's up close to $17 a share. I think I would put them, if we're talking culture, I think the top two, just culture of excellence and everyone working in tandem and everyone having the same goal. I think Costco and Adyen are my two best in the world, because they not only say it, but they do it, and they do it well, and it shows up in the results. And for anyone that wants to know, their most important KPI, or maybe one of their most important KPIs, is total process volume. In 2015, they processed 32.2 billion. Let's see, I'm making sure I'm getting this correct. Euros in process volume. In 2024, they processed 1.3 trillion, and that has grown at a 51% annual rate since 2015. So quite impressive growth. They're stealing so much market share from everyone else. And as you mentioned, competing against these Frankenstein monsters that can't provide the same value, I just think that competitive advantage is going to grow and grow and grow.
Yep, me too. Yep, big fan.
All right.
Who's your fourth one?
My fourth one, and this is a smaller company, a little unknown, but it's one that has been, it's been a winning stock for me, but unfortunately not as winning as it should have been, because I decided to sell, and that is Sprouts Farmers Market's Jack Sinclair. If anyone has listened to Chit Chat Stocks knows I've talked about this company ad nauseum for the last 5 years, positively, negatively, and kicking myself for selling the company because it's gone up so much after I sold. But essentially, Jack Sinclair, he was the VP of U.S. grocery at Walmart, and he decided to come down to Sprouts Farmers Market and take over this health-focused grocery chain that was losing traffic and desperately keeping people around as coupon clippers, which were severely reducing their margins. After joining, he joined in 2019, just for context. He navigated the pandemic craziness, which just totally, managing a grocery business during the pandemic whiplash has to have been difficult. He ripped the Band-Aid off at the same time of these coupon clippers, which destroyed comp sales. And he did this. It spooked the market. Everyone was freaking out, but it improved their margins. It got them self-sustaining, and not in a desperation sense where they had to do this. They right-sized their store count. They focused on expansion in a few key markets that were working. They improved their supply chain to just do the right things when trying to build a health-focused grocery chain, which is, one, targeting those farmers or businesses that, are not the Coca-Colas, but the smaller ones that these health-focused shoppers you can match up with and go, oh, this is an organic whatever from my Colorado farmer. Oh, okay, I like this. I'll spend $5 on this instead of what it would cost $2 at QFC. And by doing this over a multi-year period and kind of doing the right things and just doing everything, it wasn't some genius move, but just intelligent stuff running a grocery chain. Again, I think this is a lesson where, I don't know who it was. It might have been Peter Lynch, but some famous investors, some successful investors said it's a really good indicator if a vice president or some leader at a large company steps into a CEO role at a smaller company to kind of do their own thing. And that's what Sinclair did. He was in charge and really succeeded with as being the VP of grocery at Walmart. And now he came down here. It's kind of a good positive indicator that they know what they're doing. They can lead something to scale. They can do all the right things. So again, they brought comp store sales from negative, that it was negative for a while, to positive, I think 10%, maybe 11% last quarter, which is absolutely phenomenal.
Yeah, that's crazy.
And at the same time, while the stock was trading at sub 10 times free cash flow, which it's not anymore, unfortunately, he pounded the buyback program like it was his last chance to return capital to shareholders. I think the share count's down 50% in the last 10 years now. It's down, I think, 30% since he took over. Adding all this together, the stock is up, I think, around 10 times since he took over. So I just think he's really good, maybe one of the best grocery operators out there in a competitive industry where you have the Amazons, the Costcos, and the Walmarts of the world. They have such scale. He was able to carve out this niche for Sprouts Farmers Market that is giving them they're not going to be a sizable part of the grocery business, but is giving them a long runway to grow, even though they're competing with Whole Foods, which is owned by one of the largest technology companies in the world, Amazon.
Right. Yeah, that's an amazing story, and I love the fortitude to have the will to do what you know is right, even though you're going to take it in the teeth, and not only from a reputation standpoint, but also from negative press, a lot of pressure from other shareholders to get things moving, so to speak. And it probably to his pocketbook too, because some of his incentive was probably based on some of those things that he was trying to change the course on the direction. And that's not an easy thing to do. And as you said earlier, reinvigorate the business by doing the right thing I love that. And that is definitely something to aspire to and look for.
Yeah, and think about from a customer standpoint in these existing markets that they're in, if someone was a shopper at Sprouts Farmers Market, but then that old management team kind of soured them on the business, it's hard to get someone to come back.
Oh, yes.
And the fact that they were able to do that is quite smart. Another thing they did was they had to be, they can't compete with the Kroger's doing the same thing that Kroger does. So they decided to scrap all physical marketing, only do this email loyalty program where they would have these kind of, it's not necessarily coupon clipping because they decided to get rid of that, but they wanted to embrace the treasure hunt aspect that is really successful at a Trader Joe's or a Costco.
Right.
And you're not going to Sprouts Farmers Market to pick up a Coca-Cola and Bounty paper towels. You're going to go there to find some niche plant
garlic stuffed olives like I found at Costco last weekend.
Yeah, exactly. So they want to build that out, and it seems like so far it's successful. And if they can get anywhere close to the Trader Joe's traffic, I mean, this thing has a long runway to grow. And yeah, I think again, it's that combination of the strategic vision plus at the same time combining that with capital allocation. It's only two things that you have to be good at, but I'd say 99% of management teams don't have either.
No, and they don't. And I mean, I heard Buffett talking about this, about why maybe some struggle with it. A lot of them come from like a marketing background, or, maybe they were in operations and they've never had to deal with some of those main decisions they have to make. And so it helps explain a little bit sometimes why they're not great at capital allocation. Not all of them, but sometimes you can kind of understand why they may struggle at it at first. But to your point with some of the people you've listed here today, like Brian Chesky, it certainly wasn't something he had any background in, but he's learning how to do it. And I think Zuckerberg would be exactly the same. He didn't know how to do it, but he's learning how to do it. And the better they get at it, especially with companies like that can generate so much cash flow, the world could be their oyster.
I work really hard to find the best insights I can every single month at Value Spotlight. To see a sample of my previous work, go to stockwriteup.com.
I agree. All right. What's your number two?
My number two is David Velez of New Bank, or New Holdings. I call it New Bank, but I know that it's really New Holdings. So they have a 2-year CAGR of 65% over the last 2 years. And they went public about 3.5 years ago. And if you look at their CAGR over that period, not so great, but over the last 2 years, it's been 65%. So their return on equity this last year was 28%. And for a bank, that is redonkulous. Most really good banks are happy if they can do an ROE of like 12 to 15%. And these guys are almost doubling that. And a lot of that stems from their business model, which is an online bank only. So they do not have any branches. And so that gives them a lot more liquidity as well as profitability than Banco do Brasil or Itaú, which are two of the bigger banks in Brazil. So one of the things that I like about David is he really has focused himself and the team on creating a product for a need. He moved to Brazil. He's not originally from Brazil. He's actually, I think he's Brazilian, but he was educated here in the United States. When he moved back to Brazil, he went to one of the legacy banks to open an account. And I think it was 4 hours later, he still didn't have his account opened. Now, as somebody who's worked in the banking industry, I know it can take a little bit, but that's a long time. And sometimes my wife told me that sometimes it can take you 2 or 3 days to open an account in a bank in Brazil because they have so many regulations. Their customer service is quite bad. So he got mad and he talked to his friends and they decided to fix the problem. And so they started New Holdings or New Bank as a way to compete against the legacy banks and to work with technology to offer banking products to the underserved of Brazil. And now they're expanding into Colombia and Mexico as well, and doing roughly the same thing. Banking in South America is a little different than here, and I won't go into all that nitty gritty, but really one of the things that I like about what they're doing is David and the team have really set up this idea of we're going to do what's best for the customer and we're going to build products that help them as opposed to screwing them. So they don't charge fees for overdrafts. They don't charge fees for having an account. They don't charge fees for a lot of things that the legacy banks in Brazil do. And so that, because they're dealing with people that don't have a lot of money, that is appreciated by those people. And because they make it easy to open the accounts, they're super simple to open. You can do it on your phone. Most people in Brazil don't have laptops, for example. And so they can execute most of their products, all of their products, on a phone. So they can invest, they can buy insurance, they can have a savings account, a checking account, a credit card, all these things that were not available to a vast majority of Brazilians 5 years ago, 7 years ago. And so that to me is something that is really amazing. And he wants to help people. And he, again, is not taking a big salary. And he and his team are not taking big salaries. And they are really, really focused on trying to help the poor of Brazil, Colombia, and Mexico in particular become banked. And I just love their mission. And I've heard him talk. He's very passionate about what they're doing. And I'm a big fan.
And this is another one where the numbers speak for themselves. I'm looking at a FinChat chart here on monthly active customers. 2017, 2.6 million.
Mm-hmm.
End of 2024, 94.9 million monthly active customers. And I think half of adults in Brazil now use the product.
Mm-hmm.
Do you think one of the keys here was the perfect, maybe not perfect timing, but really good timing, catching lightning in the bottle,
Yes.
where the smartphone allowed this to happen?
Yes.
And they were the ones to do it the most intelligently, building out on this just new age, new opportunity for the people that didn't have traditional computers in these markets.
Yeah, unquestionably. They definitely caught lightning in a bottle by creating what they did when they did and continuing to evolve it. The other thing that has helped them was the legacy banks, kind of the perfect example of like the whole innovator's dilemma from Clayton Christensen. They sought out to serve a niche product. They started off small. They started off online, and it caught fire. And the legacy banks were slow to recognize the threat that New Holdings was presenting to them. And because they were slow, because they're kind of big, cumbersome dinosaurs, it's taken them a really long time to evolve their technology to even come close to matching what New Holdings was 5 years ago, let alone today. And so I think those things have really helped them be successful.
All right. My last one, Dave. This is one you're probably unsurprised with seeing, and this is the largest position in my personal portfolio. It is Nelnet. I'm kind of cheating here because similar to Berkshire Hathaway, they have a chairman who was the founder of the company, but unlike Buffett, he has decided to step back into just an executive chairman role and not be the CEO. So I'm choosing two people here that essentially run the company in capital allocation. It's Michael Dunlap and Jeff Nordick. I think Nelnet, and there are other people that like other Berkshire clones out there, I think this is the one true heir to the Berkshire throne, really, because it stays out of the limelight. It doesn't like media, similar to Mark Leonard, although I'd say maybe Constellation Software as well, though it's just not the same type of business because they're just really the not a general conglomerate, but the roll-up of vertical software companies. And Nelnet just wants to do its thing, allocating capital. Funny enough, it's also in the other Nebraska city that's decently large, Lincoln. So that has nothing to do with it, but it is interesting that they're both from Nebraska. Now, Dunlap and Nordick have built, with other people, a diversified set of assets that are tax advantaged, They gush cash flow, and they've grown book value per share, including their dividend payouts, at a mid-teens rate, even though the accounting statements, and I won't go into the details here because we don't have time for that, but the accounting severely understates the true intrinsic value of their assets. For example, they have a 22% stake in Huddle, which is a software company for sports film and just analysis. Anyone that follows high school football or has a kid in high school sports will know what I'm talking about. That company generates reportedly about $750 million in revenue, and I would assume get a 3, 4, maybe 5 times revenue multiple in the public markets. Now that's holding the value of their stake at about $100 million or maybe even less, when it should be most likely worth probably $500 million, maybe even $1 billion. So again, that's just an example there. And on top of it, again, I sound like I'm beating a dead horse here. They consistently return capital to shareholders through share repurchases. I think that's the number one theme, and maybe what listeners can pick up on is my favorite thing is a consistent repurchaser of stock, as long as shares remain cheap.
Yeah, it is unquestionably a fantastic business. I frankly had never heard of it before you guys mentioned it on your show. And I have read some of their 10Ks and read through some of their stuff, and it is an intriguing business. I need to do some more work on it. One of the things I liked about it was they owned a payments business for schools. So super sexy, but
private Catholic education. Yeah.
Right. Yeah. Right.
The hot market.
Right. Hot market. But, the payment geek in me was like, okay, it's needed. And if it's done well, it can be very beneficial to the customers as well as the business. And so that was something that I know intrigued me. And I know you and I talked a little bit about their Huddle segment and how that really kind of impacted their business. And yeah, I really liked it. So, put you on the spot. What is their capital, like their buybacks? Like how much have they reduced the ownership over the past years? So if you want to take a stroll through.
I can pull it up quickly. Yeah, they are not, they're not as aggressive as Sprouts Farmers Market, but I think that's okay because how should I say it? They have plenty of things that they can reinvest in. And there are some intricacies with the business that they had part of the business that got taken out. Not taken out, but the new law prevented them from doing it anymore. So they had to pivot the business. If we look at 2015, I'm pulling up a chart here on FinChat. 2015, 44 million shares outstanding. At the end of 2024, they had 36.3 million. So they've been reducing it at 2% a year, along with paying a dividend. So I'd say, and it looks pretty consistent on this chart, the pandemic and this interest rate scare, given they're a financials company. They paused it in 2022, but it's been pretty consistent. And I just think with their ability to generate good ROEs, generate a good increase in book value, having these discounted assets held on the balance sheet, that should be worth more eventually when Huddle gets public or whenever it is. You got to be patient. It's kind of a sum of the parts story, but if they're taking shares outstanding down by 2% a year, that is just going to be a nice extra lever over the long term that will really help increase returns for shareholders like myself.
Yeah, for sure. There's got to be something in the water in Nebraska, right?
I think it's that. Yeah, I don't know. Maybe there's nothing else to do over there.
Well, as somebody who grew up in Iowa, I can speak to that directly. Yes, that is correct.
Yeah, exactly. All right. What is your last company?
I'm gonna go with another, I guess not mini Berkshire, but Alto Berkshire, and that's Tom Gaynor of Markel. So Markel has generated a 5-year CAGR of 13.9%, which is not too shabby. And the return on equity has been 12.5% over the last 5 years. So some of the things that I like about what Tom is doing is similar to what Berkshire has done. He has helped build a world-class insurance business that kind of specializes in specialty insurance. And so they've found a niche and they've become really good at filling that need for their customers. They've also built a separate arm of the business called Markel Ventures, which is the part of the business that owns other businesses, so retail businesses, things of that nature. So it's all very, very Berkshire-like. So they have an insurance business that generates a ton of float. that they can use to buy other businesses like Markel Ventures to generate cash for them. And then Tom also uses the float to invest in equities, which gives them more return on their investments than other insurance companies. So most companies like an Allstate, Progressive, Prudential, most of them, when they generate a float, which is basically the money between when they take in a premium and when they pay it out, the time period between that income generation and having to pay out for a claim, it's called float. And that is money that insurance companies can use for their own purposes. And depending on the business, most property and casualty companies will invest in bonds because they're safe. They have a lot of liquidity and they earn steady, safe returns. But Tom Gaynor, like Buffett, believes that he can invest safely and well with that money in the stock market and generate good returns for the company. And so that's what he has done, is he's built up a large equity portfolio, kind of like Buffett. And that's another value add for people that own Markel, is they get this great insurance business. They get this great other collection of businesses, Markel Ventures, and they also get an equity portfolio that generates great returns and builds more value and book value for Markel. And so this is a company that's actually been around since the 1930s. So they've been around for a long time. And Tom is, I think, like the 4th or 5th CEO of the company. Before this, he was the chief investment officer, and now he's been elevated to the CEO more recently. I've heard a lot of interviews with him, and William Green wrote a chapter about him in his book, Richer, Wiser, Happier. And he is definitely a good guy. He knows what he's doing. He's smart, and he's smart enough to know that he doesn't know everything. And so he's always open to learning more and more stuff. And I just like the way he carries himself. And I think his philosophy is right on the mark.
And those returns have been quite strong over the long term. I think I saw 20,000% just looking at the Google Finance chart, which might be missing a few things. But regardless, I think it's a great way to end it.
Yeah. Yeah. So I think these are a strong collection of CEOs. Of course, there's millions other ones out there, and there's some not so great ones, but hopefully this can help people identify what we think are good ones and try to use those characteristics when they're analyzing a business. Say, okay, hey, did these people allocate capital? Do they buy back shares like Brett likes? How do they do things? And I think that's what can be really helpful for people.
I agree. Yeah, nothing else to add.
Okay. All right. So as we wrap up, if people are like, I like this Brett guy, where can I find out more about him? Where else are you online?
Okay, you can do so on Twitter/X at @CCM_Brett. You can also just look up the Chit Chat Stocks podcast on Spotify, YouTube, Apple Podcasts, or on Substack. We do a newsletter along with the episodes that you can stay updated with the show as well. So I would say Twitter, Substack, or whatever podcast player of choice you like to listen to.
Yep. For sure, follow them on socials, and for sure, subscribe to the show if you haven't already. It's easily one of my favorites. So with that, we'll go ahead and sign us off. You guys go out there and invest with a margin of safety. Emphasis on the safety. Have a great week, and we'll talk to you all next week.